Are you tired of feeling like you're always playing catch up with your finances? Wondering how some people seem to have a smooth financial journey while others struggle? It's not luck, it's strategy. In today's world, where financial uncertainty is more common than ever, understanding how to make your money work for you is the key to long-term stability. Imagine having a plan that not only keeps you afloat during tough times, but also sets you up for a life of financial freedom. Sounds good, right? In this video, I am sharing the top 8 money strategies that can improve your long-term stability. Let's dive in. 1. Build a multi-layered emergency buffer. The first strategy to help you build a solid financial foundation is creating a multi-layered emergency buffer. Instead of just tossing a small amount into a savings account and hoping for the best, you need to create a structured approach. Start with an immediate tier. Keep enough for 1 month of expenses in a regular savings account that you can access instantly if something unexpected comes up. But don't stop there. To protect yourself from longer-term setbacks, build a stability tier that holds 3 to 6 months of expenses. This amount should go into a high-yield savings account or a money market fund, where your money can grow while staying accessible. The key is ensuring that this money isn't tied up in high-risk investments, so you can rely on it during times of need. If you're self-employed or have dependents, consider increasing this buffer to 9 to 12 months to ensure you're fully covered in case of an emergency. This additional safety net will give you peace of mind, allowing you to focus on growing your wealth rather than worrying about short-term disruptions. 2. Implement a barbell investment approach. Next up is the barbell investment approach, a strategy that offers both safety and growth. The idea is simple but powerful. The majority of your investment portfolio, think around 80 to 90%, should go into low volatility assets like index funds, bonds, and cash. These investments provide stability and safeguard your wealth. But here's the twist. The remaining 10 to 20% should be used for higher risk, higher reward investments. This is where you can invest in emerging technologies or alternative opportunities that offer significant growth potential. This approach helps you avoid the pitfall of moderate risk investments that provide little to no meaningful growth while still offering some level of protection. By placing your focus on extreme ends of the risk spectrum, you minimize the chance of being caught in the middle with mediocre results. The goal is to achieve long-term stability through the safer portion of your portfolio while still positioning yourself for potential explosive growth on the riskier side. 3. Shift toward global diversification. If you've been putting all your resources in one basket, it's time to rethink your strategy. Global diversification is a crucial step in securing your financial future. Relying on a small group of tech stocks or just a handful of familiar investments can leave you vulnerable when those stocks underperform. A more resilient approach is to branch out into international markets, where opportunities for growth often exist beyond your home country. Countries like Japan or nations in Southeast Asia have balanced leadership and more attractive valuations. Not only does this help balance risk, but it also opens up your portfolio to industries and economies that may not be fully represented in your home market. Additionally, as emerging markets such as India continue to grow, their economies offer unique chances for returns driven by domestic consumption. By gradually increasing exposure to these growing markets, you tap into new areas of growth that can provide diversification and safeguard you against regional downturns. 4. Optimize for inflation hedging and resilience. With inflation constantly eroding the value of money, it's important to optimize for inflation protection. One way to do this is by investing in tangible assets like gold and silver, which are well known for protecting against inflation and geopolitical uncertainty. These precious metals act as a safeguard for your wealth when currency values drop. In addition, consider inflation-protected securities, such as Treasury Inflation-Protected Securities, TIPS, which adjust with inflation, ensuring your purchasing power doesn't shrink over time. This type of bond can be a great way to ensure that your investments retain their value even when inflation spikes. Real estate is another great option to hedge against inflation. Rental properties or real estate investment trusts (REITs) often see income increases that naturally keep pace with inflation, making them a smart addition to any diversified portfolio. Over time, these investments provide not just protection, but also the opportunity for passive income as property values and rents rise in line with inflation. 5. Automate savings and debt repayment. One of the best ways to stay consistent with your financial goals is by automating your savings and debt repayments. When your paycheck hits, set up automatic transfers to your savings and investment accounts. By doing this, you treat saving and investing as non-negotiable, just like paying your bills. This eliminates the temptation to skip a month, especially when the market is volatile or when lifestyle pressures kick in. With automation, you build a savings habit that works for you in the background, without needing constant reminders or willpower. Along with savings, automation can also help you tackle high-interest debts faster, especially credit card balances, which can sabotage your long-term wealth if left unchecked. By automating extra payments to high-interest debts, you'll not only reduce your liabilities quicker, but also improve your credit score, creating a stronger foundation for future financial decisions. 6. Prioritize human capital over portfolio returns. Another powerful strategy is focusing on human capital over portfolio returns. While investing is essential, your ability to earn money is your biggest asset. If you want to create real financial stability, focus on increasing your income through upskilling or seeking higher-paying roles. Often, the return on investing in your career, say a 20% salary increase, far outweighs the returns you could expect from a 2% gain in your investments. This strategy is about leveraging your skills, expertise, and network to open doors to higher-paying opportunities. By continuously investing in your personal growth, you improve your professional value, which can lead to long-term financial gains. Additionally, building side incomes like freelance work or starting an online business can provide reliable cash flow, reducing your reliance on a single paycheck and allowing you to weather financial storms more easily. The goal is to create multiple streams of income, ensuring that if one source dries up, others can sustain your lifestyle. By diversifying your income sources, you enhance your financial resilience, giving you more freedom. 7. Enforce a 24-hour spending rule. A small but highly effective way to keep your finances in check is to enforce a 24-hour spending rule. The next time you feel the urge to make a non-essential purchase, hold off for at least 24 hours. This simple rule can help you combat impulse buying, ensuring you make purchases only after careful thought. By practicing mindfulness in your spending, you'll uncover areas where you might be wasting money, like forgotten subscriptions or impulse buys that don't add real value. This cooling-off period allows you to assess whether the purchase is necessary and aligns with your long-term goals. Rather than splurging on trendy, overpriced items, invest in high-quality purchases that will last longer and offer more value in the long run. You'll start to prioritize the value of your purchases over the instant gratification that impulsive spending brings. 8. Use intermediate-term bonds for ballast. Finally, to add resilience to your portfolio, consider using intermediate-term bonds as ballast. Bonds with maturities of 5 to 7 years strike the perfect balance. They offer higher yields than short-term bonds, while avoiding the high price fluctuations of long-term bonds. This makes them an ideal choice for maintaining stability in times of market volatility. Including these bonds in your portfolio ensures that you have a steady stream of income, especially during times when stock markets experience downturns. By diversifying with bonds of varying maturities, you can build a more robust and resilient investment strategy that will help you weather any economic storm. This adds an element of safety to your portfolio while allowing you to continue growing your wealth over time. And there you have it, top 8 money strategies that improve long-term stability. And remember that financial stability doesn't come overnight. It requires careful planning, smart strategies, and consistent execution. By building a multi-layered emergency buffer, diversifying your investments globally, protecting your wealth against inflation, and prioritizing automation and human capital, you set yourself up for lasting success. If you found these strategies helpful, don't forget to like, share, and subscribe to the channel for more tips on securing your financial future. Also, let me know in the comments which strategy you found the most useful. Thanks for watching, and I'll see you in the next video.